welcome to the week that was. We are kicking off 2026. And it feels like the ground beneath the digital asset market is shifting faster than ever.
It really is.
Our mission today is to dig into all the reports and really distill what's happening structurally, because it's clear the old rules just don't apply anymore.
They certainly don't. I mean, if you just look at the aggregated flows, the policy announcements, everything that defined the new year, the market is going through what we're calling the Great Bifurcation.
The Great Bifurcation. Okay, so what does that actually look like?
It looks like tourist capital leaving, definitively. The weak, speculative hands are, getting flushed out.
Okay.
But the space they're leaving behind is being filled, and aggressively, by institutional players, by massive corporate treasuries, and, this is the critical part, by sovereign entities.
So it's not just a trading vehicle anymore.
No, not at all. It's being integrated as critical national infrastructure.
And just to underline that point, the narrative that was basically gospel for a decade, that simple 4-year halving cycle thesis, that's functionally dead.
Oh, it's shattered, frankly. I mean, think about it. Bitcoin opened 2025 above $93,000. It closed that post-halving year down about 6.3%.
Which should not happen, according to the old model.
It's a statistical anomaly that just completely invalidates those simple supply-driven models that, so much retail speculation was built on. Bitcoin has financially matured.
So the new rules are about institutional demand, global liquidity, not just code.
Exactly.
Okay, let's unpack this new reality then. We need to cover the price volatility we saw, that massive flow reversal in the ETFs, and then the geopolitical moves that are really redefining this whole asset class. So let's start with that technical struggle. For Bitcoin, it feels like the big psychological battleground right now is $90,000. Why is that number so important?
It's just where the density of selling pressure is. It's an iron ceiling. We saw a textbook demonstration of that liquidity just this week.
This vertical repricing attempt.
Exactly. Bitcoin tried to spike right through it, but the moment it went just a little over 90,000, it was immediately and forcefully rejected.
Confirming that's the line in the sand for now.
It is. And then we saw that rejection followed by a classic bull trap, right? The price pushed up again, but the rally just stalled out almost instantly.
What stalled it?
It was systematic selling pressure. On one hand, you had significant distribution from industrial miners, locking in profits on that rally.
On the other,
unexpected ETF outflows, nearly $20 million. And what's really notable is that even BlackRock's IBIT, which almost never sees redemptions, had a brief outflow.
So that sounds like tax loss harvesting right up to the deadline.
That's the weed. Institutional players were creating some temporary supply right at year-end, but then just as the year closed, we saw a critical defense.
A huge psychological win for the bulls.
Absolutely.
Yeah.
The market successfully defended that crucial $86,700 level. For anyone watching the charts, that was the most important support line from the last rally.
And the fact that big limit bids were sitting right there.
It confirms that smart, long-term money was waiting to step in at the exact moment the tax sellers and tourists are getting out.
So as we're talking now, the price is pivoting around 89,720. What's the immediate technical picture?
Well, it's a solid recovery effort, and it's backed by real volume. But the critical resistance objective is still $91,541.
The 50-day exponential moving average.
That's the one. It's basically the average price trend over the last 2 months. A sustained daily close above that line is the signal that we're entering a new medium-term uptrend.
So what does all this mean for you, the listener? If the old 4-year cycle is dead, how should you be thinking about Bitcoin today?
The shift is profound. Bitcoin isn't this isolated, idiosyncratic asset anymore. Because of the ETFs, it's now deeply woven into traditional finance.
So it's correlated with global liquidity, things like M2 money supply.
Real interest rates, central bank balance sheets.
Yeah.
Yes.
Yeah.
It's behaving much more like a mature, high-beta tech stock than some unassailable commodity. You need to watch the ETF flows, not just the block reward schedule.
Which brings us right to those flows and the dramatic reversal we saw that confirmed that famous January effect.
The change was just breathtaking. I mean, after a really punishing 7-day streak of outflows, purging those weak hands,
The market flips.
it flipped hard. U.S. spot ETFs saw a net inflow of $355 million, followed by a massive $471.3 million inflow on the first major trading day of 2026.
That is a loud statement.
It's a statement of long-term conviction, and BlackRock led the charge with what? Nearly $290 million in inflows in one day. That just screams long-term structural demand from large endowments from financial advisors.
And maybe the most important signal, even Grayscale posted positive flows, after being the source of so much selling pressure all of last year.
That is probably the most significant structural signal of the week. It suggests that major rotation trade, investors selling the high-fee Grayscale trust to buy the new, cheaper ETFs, that might finally be over.
So the structural headwind that defined 2025 could be lifting.
It seems to be.
And all of this is being fueled by the big corporates, continuing what we call the corporate central bank model. MicroStrategy just bought another 1,200 Bitcoin.
For over $108 million, their constant buying, it acts as a critical soft floor for the market. They just keep taking supply off the table, regardless of short-term price.
And then there's Tether.
Right, the stablecoin issuer. They confirmed they bought another, 8,888 Bitcoin in the fourth quarter. Their total holdings are now over 96,000 Bitcoin.
They act as this buyer of last resort. But isn't that just using stablecoin profits to prop up the price? I mean, that feels like a huge centralized risk for an asset that's supposed to be decentralized.
It is absolutely a point of friction and a big debate. While their buying provides a reliable floor, you're right, it confirms that a single, very opaque entity has immense influence. It really highlights that the most powerful buyers today are often the most centralized.
And this isn't just a U.S. thing. MetaPlanet, the MicroStrategy of Asia, also confirmed a huge buy.
The huge one, over 4,000 Bitcoin for $451 million. But what's fascinating is their average purchase price was much higher, around $105,000.
Why so much higher?
Because their strategy is less about dollar cost averaging and more of a pure macro wager. They executed a classic yen-sink carry trade.
So, in simple terms, they're borrowing cheap Japanese yen to buy U.S. dollar-denominated Bitcoin.
Exactly. They're betting the yen devalues against a hard asset like Bitcoin much faster than the interest they have to pay. It's a pure currency bet.
And we have to mention this value inversion anomaly with hyperscale data. Their Bitcoin and cash holdings are worth more than their entire company.
117% of their market cap. It's a stark inefficiency. The stock market is essentially assigning a negative enterprise value to their actual business, their AI data centers.
So if you buy the stock, you're getting Bitcoin at a discount and an entire AI operation for free.
It's a clear invitation for an activist investor to step in and force them to unlock that value.
So we have corporates acting like central banks.
What?
But now let's look at what actual nation-states are doing. This is where that great bifurcation gets truly geopolitical. Let's start with China's yield war.
This is a total economic game changer. The People's Bank of China announced that, starting this year, commercial banks will pay interest on digital yuan wallet balances.
Okay, so that shifts their CBDC from being like digital cash, which is M0,
Right, non-interest bearing.
to being more like a savings account, an M1 or M2 instrument. Why does that matter to someone outside of China?
Because it's a direct calculated yield war against U.S. dollar stablecoins like USDT and USDC.
Which don't typically pay interest to the end user.
Exactly. So by offering a risk-free, state-backed yield, China creates this huge gravitational pull to keep capital inside its own banking firewall. It could reduce the liquidity that might otherwise flow from Asia into global crypto markets.
That's economic warfare via digital currency. Then, on the literal warfare side, we saw the formal weaponization of crypto.
Tragically, yes. Iran's Ministry of Defense has formally integrated crypto into its military export infrastructure. Their platform, Mindex, is now offering advanced weapons missiles, drones for digital currency,
So they can bypass the global financial system completely.
and secure hard currency to continue their arms trade. It creates a massive regulatory tail risk for Western governments trying to enforce sanctions.
And then you have the complete opposite approach, the energy stack strategy led by El Salvador.
Right. El Salvador just launched a new policy framework integrating their Bitcoin treasury, now over 7,500 BTC, with AI infrastructure.
Using their geothermal energy to power both mining and AI compute.
Exactly. They're positioning themselves as a sovereign data haven, monetizing a natural resource into both hard currency and future tech infrastructure.
It's a brilliant playbook for any energy-rich, cash-poor nation. We should also note they made Bitcoin acceptance voluntary again.
Which is a very pragmatic move, most likely to secure a big IMF loan without having to abandon their Bitcoin treasury entirely. It's a political calculation.
And we're seeing others follow that energy playbook.
We are. Turkmenistan just legalized mining and exchanges. Another energy-rich nation moving to monetize its natural gas directly into hard currency to bypass banking bottlenecks. This is the new global alignment.
Okay, let's pivot to the hardening phase, the new regulatory regime that is slamming the door shut on the gray zone for users everywhere.
The surveillance net is now tight, and it's global. The Crypto Asset Reporting Framework, or CIRF, is now operative in the UK and over 40 other nations.
And this forces exchanges and brokers to collect granular data on their users.
Tax IDs, everything. But the most, frankly, chilling detail is that it extends beyond just exchange accounts.
It extends to self-hosted wallets.
Correct. When you withdraw Bitcoin to your personal hardware wallet, the exchange has to log that transfer as a reportable event and attribute that destination address to your tax profile.
And that data will be automatically shared among all partner nations.
Starting in 2027, covering transactions from this year onward.
And here in the U.S., the new IRS Form 1099-DA is closing the tax loopholes.
Right. Brokers now have to track cost basis. The clear result of all this is bifurcation. The market is splitting into a transparent, compliant segment with deep liquidity and a non-compliant segment that will have immense trouble off-ramping to fiat. This is the end of the unregulated era.
So while governments are watching the exit ramps, the actual entrance ramps are where the security walls are crumbling. The application layer is the new battlefield. We saw that $8.5 million trust wallet attack.
A devastating attack. And it wasn't a flaw in the blockchain itself. The attackers managed to upload a malicious browser extension to the official Chrome web store.
So it exploited trust in the distribution channel.
Precisely. It's a huge warning against holding any serious capital in a browser-based wallet.
And that wasn't an isolated incident. We also saw that EVM wallet draining campaign hitting hundreds of wallets across multiple chains.
That campaign used very sophisticated salami slicing tactics, siphoning off small amounts, like under $2,000, specifically to fly under the radar of automated alerts.
So theft is becoming industrialized.
It is, and the Slowmist 2025 security report confirmed it. The number of attacks actually went down, but the severity of each attack increased by 46%. The ecosystem lost nearly $3 billion. Custody is still the single biggest operational risk.
Let's shift to innovation outside of Bitcoin. The altcoin space is seeing its own structural maturity, starting with this surprising revenue flipping.
Solana has officially flipped Ethereum in fee generation over the last year. It generated about $1.5 billion in revenue compared to Ethereum's estimated $600 million.
Now, that doesn't mean Ethereum is dying.
No, not at all. But it strongly validates the high-throughput economic model.
Where velocity matters more than the size of the fee. Ethereum has pushed its volume to layer 2s, but Solana captured that value through sheer speed, especially in the meme coin and DeFi sectors.
We're also seeing DeFi mature in a very institutional way. The real-world assets, or RWA sector, has now overtaken decentralized exchanges to become the fifth largest category by TVL.
$17 billion. So institutional capital is moving on-chain for things like tokenized treasury yields.
This is the adulting of DeFi.
And institutional strategy is now expanding way beyond just Bitcoin. Look at what Bitwise did with their regulatory blitzkrieg.
It was a coordinated strike. They filed for 11 new single-token ETPs all at once, targeting assets like Uniswap, a Calve, Zcash, a privacy coin, which is notable, and Bittenser.
They're trying to colonize the entire Web3 tech stack.
And become the primary regulated entry point for everything that isn't Bitcoin or Ethereum. It's a high-conviction bet on specific sectors they believe can pass regulatory muster.
Meanwhile, Av Labs proposed a major governance pivot, sharing revenue with token holders,
which creates a powerful quasi-equity model. For years, governance tokens just gave you voting rights. By proposing to distribute real revenue, they strategically sidestep some regulatory issues while immediately driving the token price up as investors priced in actual cash flow.
So we're seeing this widening ideological divide here. On one side, you have Vitalik Buterin's manifesto calling for adversarial interoperability, prioritizing privacy and censorship resistance.
And on the other side, you have the total normalization of political finance, like the Trump media partnership with Crypto.com to issue digital reward tokens to shareholders.
Where digital assets are used for corporate loyalty and political engagement.
Exactly. Compliance and convenience over decentralization. The market is clearly splitting between the resilient, difficult systems and the convenient, corporate-friendly ones.
So as we wrap up the week that was, what is the core takeaway for you, the listener?
The market is a coiled spring. The selling pressure we saw at the end of December, which was mostly tax-related and rotational, was absorbed incredibly quickly by deep, long-term structural demand.
And that $471 million ETF inflow just confirmed it.
It confirmed the institutional price floor is hardening, and the speculative tourists are gone.
So the market has left that retail-driven, lawless frontier town, and it's entering a new, highly industrialized, monitored, regulated city.
That's it exactly. And in this new city, value will accrue to assets and strategies that offer specific kinds of resistance. Resistance to surveillance, like privacy tech, and resistance to censorship, like decentralized layer 2s. The game is shifting entirely to utility and security within this new structure. And that structure leads me to one final provocative thought. We saw that Ilya Lichtenstein, the Bitfinex crypto thief, was released early under the First Step Act, a sign of leniency for high-profile, white-collar crypto crime. At the same time, the state is building tools like CARF to track average users, and critical infrastructure hacks are now demanding ransoms in Bitcoin. So you have to ask yourself, in 2026, which is the higher risk? The security of the network or the security of your own keys in a world where physical freedom and digital assets are treated very differently by the legal system depending on the scale of the crime?
A really complex question for a very complex new year. That is all the time we have for this deep dive into the structural shifts of the market. We will catch you next time for the week that was.